Now, all the time, people, when they talk about getting to a commercial deal or any type of real estate deal, first thing they want to think about is like they want to get into a deal and actually own a property and buy a property. But before you can actually look at properties, you really need to understand the market, understand where you buy. The saying in real estate is location, location, location. It's the number one most important thing that you need to understand before making a purchase and being able to analyze a market. Now, of course, some markets are going to have advantages to others. Some markets are going to be better for investing depending on the strategy. But how do you really understand what location or what market is better than another? And you do that with data and numbers. You don't do that by having a conversation and your homeboy said to go invest here because he saw that, the properties was going for the low. You don't do it based off of some magazine saying that this property or this location was the best location. You do it with actual data and being able to understand the statistics and what that data is telling you in the form of just being able to tell a story on the market. Now, certain economic trends and data is going to indicate how a property is performing now and how you can project it to perform into the future. But how do you know what data to look at? And that's what I'm going to break down here in just a second. So, like any other business, real estate is going to be ran on supply and demand principles. So of course, supply is how much housing options there are going to be, whether it's other apartments or even home ownership, being able to analyze those other options, seeing what's around. And then your demand is going to come from renters, which is essentially just how many people in the market need to rent and ultimately need to rent a property like yours, because every renter in the market isn't going to be your target demographic. So it's very important that you understand your target demographic, what type of renters you're targeting, how they fit into the market, and how many of them are in the market, and what other options do they have. So very important. And now I'm going to get into what data and key statistics you can look at to be able to measure those outcomes. So first metric that you want to look at is going to be rent growth. So of course, that's pretty obvious. Rent is going to really indicate just how much revenue you'll be able to bring in, and you want to be able to see that increase over time. So the rent growth is going to really indicate what that revenue growth is going to be for your property over time. So a standard rental market should see rent increase over time just due to inflation. So you should see, a few percent, maybe 3 to 5%, or somewhere in that ballpark every year. You should be able to see that rent growth. Of course, it's going to be something over time. You may see some years where it goes down. For instance, in Atlanta right now, we're seeing rents drop as a lot of major cities after the huge rent increases following COVID, you're starting to see rents drop. But in general, a healthy market will see rents increase over time. Now, there will be added pressure to some markets, added upward pressure on rents when you have rapid population growth and a constrained supply. So if you have fewer properties in the area that, or properties are not being built to be able to keep up with demand in terms of population growth, then you'll see rents go up because of that. Now, if you want to actually see the rental trends of a particular market over time, you want to get that online data. One good place is going to be Zillow. So Zillow has the Zillow Observed Rental Index, ZORI, and I'm going to put the link to this and all the other sources that I mentioned. I'll put that in the description for you below. But that's going to really show you that Zillow Observed Rental Index is going to show you rents historically, and then you can use that to kind of see what you can trend moving forward. Also, Apartment List is going to have those rental trends and historic data for each major market. So check out both of those sources to be able to figure out what your rent growth can look like. Number two is going to be population growth. So of course, as population increases, demand for housing increases because everybody that's a part of the population is going to need somewhere to stay. On the flip side, if population declines, then over time, you'll see less demand for the housing just because there are fewer people that really need to rent in the area. So population growth is a very strong indicator of demand now and in the future. So a great source of information to be able to figure out population data is going to be the census. So of course, the census is ran by the government where they take a head count or extrapolate the head count of the population, and they do that by pretty much every type of geographic region, whether it's city, state, MSA, so on and so forth. So if you Google search census data, population by MSA, you'll be able to pull up a list of, or an Excel sheet that'll have all the different population estimates for a few number of years back for every major metropolitan area in the country. And you can use this to see how the population is trending over time, whether it's going up, how fast it's increasing, and you can use that as a way to just project the strength of the market for now and the future. So number three is going to be job growth. So people tend to move where the jobs are because that's their main source of income and then they rely on those jobs to live. So as companies announce relocations to different places or they're expanding different places or building a new facility, that's going to indicate jobs going and flowing into that region. And because of that, you can use that as a long-term indicator of population growth because people are going to move to accommodate just how many jobs there are. So job growth is a very important statistic to be able to predict your future demand for your property. Now, a great source to be able to find out job growth is going to be the Department of Numbers. So departmentofnumbers.com has some employment information where they can show the employment statistics and increases in jobs and employment for each major city, and they do that over some years. So I'm going to link it in the description, but it's going to have Department of Numbers, and you can look up major cities and you can use that to be able to see what the job growth looks like in a particular market. So number four is going to be job diversity. So job diversity is important because you don't want a city that's dominated by one or two major industries or major employers, because that can be a very big risk for your property if one of those employers or industries is hit hard in a particular economic environment. So one way to find out this information is to search top employers in X market. So I did this with Atlanta, and the Atlanta Chamber of Commerce had a list of the top employers for Atlanta. I looked at the top 20, Delta's number one, Home Depot's up there, Publix is up there. So you have a lot of major employers. And one thing I noticed is 5 of the top 10 employers are in healthcare industries. Now, in situations like that, it can be okay to have an industry dominate because healthcare is seen as a very stable industry. We're always going to need it. We're never going to have enough people in the healthcare industry, to be completely honest. So having a lot of employment in those industries diversified across multiple companies is something that's advantageous. Otherwise, you can run into an issue if an industry is hit hard. Take Detroit, for example. Everybody knows about the decline of Detroit because Detroit being the motor city, when there was an issue, the automotive industry was hit hard, it really devastated the city. The population was declining and a lot of the major companies were having layoffs, and it really affected the overall real estate market. So you want to avoid that. And a lot of times that's going to be more prevalent in smaller markets, maybe secondary and tertiary markets where it may be considered a company town, where one company, factory, or facility really dominates a lot of the employment. So just be mindful of that. So the best way to find that information is to do what I did and Google it. You may find the local chamber of commerce has that information, or one of the business publications maybe did a survey or has that information. But whatever it is, you can usually find it online if you just Google search the whatever the market is in top employers. And then you can also do the same thing for industry. Number five is going to be supply growth. So as I mentioned before, it's all about supply and demand. Supply is going to be what other housing opportunities are being built, whether they're in construction or during lease up. What other opportunities are there? What does that pipeline look like? Because that's going to indicate your competition. The more competition, the more options that people have to rent from other than your property is going to have an adverse impact on the rents that you're able to charge because the supply is just a lot higher. So one good place is to look for this is to find it on Berkadia. So Berkadia is a major brokerage firm. They also have their own lending arm and also provide insights and market reports like a lot of other major real estate firms. So Berkadia produces a quarterly construction pipeline report for pretty much every major metro in the country. I'm going to link to it in the description, but essentially you can go in there, search by region, pick out your city if it's a major metro, and you can see every single unit for each submarket of that metro. See, you can see what's in lease up, you can see what's under construction, and you can see what's planned. Now, bear in mind that a lot of what's planned will not actually come to fruition. Just have to go through permitting, zoning, get approvals, and a lot of those projects will not make it. But you can rest assured that anything that's in construction or during lease up is competition that you have to worry about. So make sure you just see what that pipeline looks like and just know that whenever you have a lot more product coming online in terms of new units, that your rents are going to suffer and you're not going to really be able to increase rents at the rate you would if those didn't exist. Number six is going to be median household income growth. So your median household income, of course, is the income for an entire household where they make, gross annually before taxes. Now that's important to know because housing is going to be a major expense to your typical person, especially renters. So their income, their household income is going to directly impact how much they can spend on rent. So as incomes go up, the amount of somebody can spend on housing is going to go up. So if you see median household income is decreasing over time, just know that the amount that somebody in that market is going to be able to pay for rent over time is going to decrease along with it. And you consider that a good portion of the population is housing burden, meaning they're paying more than 30% of their gross income on housing. Know that there's not much wiggle room there. So if household income is going down, then rents will decrease. Now, as opposed to household income going up, that's really what you want to see. You want to be able to see that income growth over time because that means that as your rents increase with inflation, the general population is going to be able to afford those rents over time. Now, there's two places where you can get this information. First is going to be datausa.io. So DataUSA has just a whole bunch of different statistics for pretty much every major metro in the country. So you can look on there for the Atlanta, Sandy Springs metropolitan statistical area, and it'll show you a whole bunch of different numbers. One of them is going to be median household income, and it's going to show the change from last year to this year, or whatever the most recent year is. And you want to see something that's pretty healthy. Now, keep in mind, as I mentioned earlier, that housing is going to be about or should be about 30% of someone's gross income. So you want to see median household incomes at a rate that can support whatever rents you're going to be targeting in a particular market. So the stronger the income, the stronger the rents you can charge. Now, the second place you can look is going to be city data. So citydata.com is a resource that just has different numbers on a whole bunch of different cities across the country. Now they're going to also have some median household income, and they're going to show some of the statistics of how that income has changed over time for each city. So get in there and look at whatever city it is you're analyzing, and you'll be able to see that median household income and the growth over an extended period of time. Now, here are a few other data points and metrics to follow that I'm not going to spend too much time on, but they're very important to note, and you'll likely want to look into those as well. One is going to be vacancy. So, of course, vacancy is just the amount of vacant units that you have in a particular market at a particular time. And it's a very good indicator to understand whether there's enough demand in the market as is, or if the market is oversaturated with units and supply is a little too high. Next is going to be net absorption. So net absorption is essentially the amount of units that are leased in a period minus the amount of units that are vacated or come online. So if net absorption is positive, that means more units are being leased than what's coming online, what's coming available. That means demand is outpacing supply. If net absorption is negative, that means supply is outpacing demand, and that's going to lead to a drop in rents, or at least prevent rents from being able to increase at a normal rate. Next is going to be net migration. So net migration is, of course, how many people are moving into a market minus how many people are moving out. So it's very important to really understand that because those trends really indicate a lot. So if you look at it nationally, you'll see that net migration into the Sun Belt is high compared to the rest of the country. And net migration in markets such as most markets in California and New York have a negative net migration because people are leaving those markets and moving into other markets, a lot of them being along the Sun Belt in Texas, Florida, Georgia, so on and so forth. Next is going to be unemployment. So, of course, unemployment is going to have an impact on the income that people make in their household, and that's going to have an effect on rents. So, of course, when we're looking at a recession, unemployment is going to go up, and that's going to have an adverse impact on rents. But at the same time, you want to look at it on a market perspective. What does the unemployment look like in a market? Because that tied to the jobs is really going to indicate just how much people are able to afford in terms of rent. And then you also want to look at crime statistics. So, of course, crime is not necessarily going to have a direct impact on your property, but crime in an area is going to have like a lagging effect because people don't want to live where crime is heavy or crime is increasing. So it's just something you want to track. And then also it's going to have an impact on your insurance rates. Higher crime areas are going to have more insurance because there's just more likely to be claims, whether it's like from shootings, break-ins, whatever it is. There's just more issues that come with operating the property, and it's going to lead to your insurance being higher. Last but not least, there's a couple other qualitative aspects to really look at into a market that you just want to keep in mind, honestly. First is going to be landlord friendliness. So, as a lot of people know, a lot of the red states are going to be more landlord friendly, but it also can come down to particular market like MSA city level. So, you really want to be able to invest ideally where it's landlord friendly because that's just going to be ease of operation when it comes to dealing with problem tenants or evictions. You'll have an easier time in landlord friendly areas as opposed to more renter friendly markets. And the next one is going to be climate change. So global warming, whether you want to believe it or not, that's going to have an impact on your real estate business. If you look at certain markets, like a lot of places in Florida right now, they're seeing huge increases in insurance as they have for years because of just the amount of hurricanes, tropical storms, and other things that hit their market. Certain markets that don't have the same issues as Florida, you'll see better insurance rates and just overall ease of operation or just peace of mind when it comes to your property because you don't really have to worry about just the same climate issues that you will in other markets. All right, so in conclusion, as I wrap up this list, it's very important that you don't take this entire list as law. There's exceptions to every single rule, and there are going to be markets that don't check off every single box or the numbers on each of these trends. Not every single one is going to look good, or they all may look bad. And that's okay sometimes. It's important to understand and remember that in every single real estate market, somebody is finding a way to invest, close deals, and make money in that market. So if you have an advantage or you have extenuating circumstances, or you're just able to really find a good deal that works, even with all of the negatives in the market, if you're able to underwrite and still be able to make a deal work, then that's fine. This list is just more so a guide, a reference point for you to be able to make some decisions, be able to make a thesis around what that market's going to do, and then invest and tailor your strategy to whatever that thesis is. Now let's get into analyzing a submarket. So of course, a market in general is going to be a metropolitan statistical area if you're in a major market, or for like your smaller markets, it may be just a city or that town. But essentially, a market is going to be larger, more broad, and then a submarket is going to be almost like neighborhoods within that market. So if you take Atlanta as example for the market, the overall market, then a submarket may be like Decatur or Stone Mountain or certain parts of Decatur, South Side Decatur versus North Side Decatur. Or you may look at like South Atlanta, College Park area, that's a submarket. So the submarket is going to be a lot more confined and it's going to be a lot more uniform as opposed to the overall market. Every single city, every single market is going to have some very good places to invest, and it's going to have some areas that are a lot rougher. And the metrics and dynamics between those places are going to be completely different. But within a market, you'll see a lot of similarities that allow you to really treat the market, that submarket, as like one different area where you can make assumptions and have a thesis for that particular submarket. So when you're looking at a deal and you're ready to analyze a submarket, here's a few things that you want to look at. You want to look at the income. So income is very important, as I mentioned before, because that's going to dictate how much people can actually spend on rent. More importantly, you want to make sure that the income is going to provide enough renters. So you can look at the site called Justice Maps. Justice Maps is going to be able to tell you, if you put in an address, it'll tell you for that particular census tract, what is the median income for that particular area. And if you have rents at $1,000, you want to be able to see the median household income be 3 times as much that. So rents at $1,000 per month means that someone needs to be making more than 3 times that to qualify in most cases. So they need to be making $3,000 per month or $36,000 per year. That will be the median household income that you'll want if you're trying to target $1,000 rents for that property. CityData.com also has that income on a particular census tract, very granular level, so you can see in that particular area where the property is, you'll be able to see what the income is. So next is going to be crime. So as I mentioned before, you want to really be able to look at crime because that's going to indicate a lot of things like your insurance. But when you're looking at it at the submarket level, you actually have a property that you identify, you really need to understand what the crime is like in that area because that's going to drive so many things. It's going to be an indicator of your operational headaches. If you're dealing with a lot of crime issues at your property or around your property, if your tenants are dealing with that. And crime also along with income can allow you to really see what that delinquency is going to be, your economic vacancy once you take over a property. Higher crime rate, lower income, you're going to see a lot more issues in terms of delinquency, problem tenants, having to deal with more evictions. And that's not to say you got to avoid those properties, but you need to understand that going in, what kind of market you're in, and make sure that you have a business plan and strategy to address those issues on the front end. Now, there's two sources where you can find this data. First is going to be spotcrime.com. So if you just search that and you can put in the address, you can see what type of crimes have happened in the however many past months in that particular area. And then mylocalcrime.com is also going to give you the same thing, more in like a list, but it's going to tell you all the different incidents, crime incidents that happened in the past few months in that particular area. And lastly, when you're looking at a submarket, it's very important that you understand the rental rates. It's one of the most important things when you're actually looking at a property that you want to acquire. If you're projecting to take rents to a certain level, you need to understand what is that submarket, what are they able to command in rents, and what do those units look like, what amenities are offered by those properties that are allowing them to achieve those rents. One great way to do this is to go to apartments.com, type in your address or find out where your property is on that map, and then look at the other property listings that come up and see what those units are renting for, see what amenities those properties have, what age those properties have, so on and so forth. And you can use that to be able to determine what are the market rents in this particular area. And that's going to really influence you in being able to underwrite and analyze your property for once you take it over. All right. Now, if you stuck with me so far, I really appreciate it just for you to be able to hang in there. If you got some value out of this so far, please go ahead and hit that like button. Now I'm going to give you a little more extra information and give you some tips on how you can become just a subject matter expert, a market expert, and know more than 95% of the industry on a particular market. Now, the best way to become a market expert is to really just stay informed and stay up to date on what's currently going on in the market. Now, that means becoming a student of the market and being a student of the game overall. But it doesn't really take as much time as you would think. It doesn't take like just hours of studying. Really only takes like 5 to 10 minutes a day. And what you do is you just sign up for some of these commercial real estate news reports or journalism sites. And you can even sign up for email lists, and a lot of times they'll send articles, quick little articles or emails to your email address every single day. Or you can just check the site every single day or a few times a week and really just read an article. Like 3 to 4 articles a week on what's happening in your market will keep you ahead of most people, because you will know every type of property that's coming online, every new development, every major trend or issue that's affecting people in your industry and in your market. You want to stay up to date on that. So a few key sources that can really help you do that. So Biz Now is going to be one. That's one I check on a pretty regular basis. They have for every major city, or not every major city, but several major markets throughout the country. They have like just articles that they'll put out almost daily. Atlanta's one of those markets that they focus on. So I have a free account with them, and I'm able to look at those articles as they come out. And I just check out a few a week, and I stay very in tune with what's going on in the market. Two is going to be Multifamily Executive. So that's more of a national one, but they'll talk a lot about what's going on in multifamily trends you see in the nation, and they'll have different stuff on major markets when something comes about. And three is going to be CRE Daily. So CRE Daily is not just for multifamily, but it'll give you some commercial real estate trends and certain things that's going on you'll see in the market. And they have an email list that you can sign up for, and they'll send you quick little emails on a regular basis that you can read through and stay informed on what's really happening in the market. And another great place for data is going to be from some of the major brokerages that I mentioned before. So don't reinvent the wheel. You don't got to go and find all your own data, do your own research on everything. These firms will literally put out whole reports on whether it's multifamily, retail, industrial. They'll put out full reports every month, some quarterly, half the year, annually, and they'll be able to put out all this information. They'll compile the data that you would struggle to find on your own, and they'll be able to break that down into a comprehensive report on major metros throughout the country. So utilize their hard work. Now, these sites I recommend are going to be Berkadia, Matthews, Cushman Wakefield, Marcus and Millichap, and Walker and Dunlop. So those are going to be major investment firms, they're all brokerages, so they handle commercial real estate transactions. But part of their role is just being able to break down and analyze data and put out reports. So just read those reports as they come out, and you'll know so much about a particular market. All right, wrap it up, Box. In conclusion, there's a lot that you can do. You can look at to analyze a market and really understand how a market is operating and what you need to do if you're investing in that market. There's a lot of data you can look at, but it's just very important that you look at the numbers and you actually follow data in your decision making, and not just what people tell you and not just what you see on the news. So hopefully this video was valuable for you, gave you some resources, gave you some idea of how to analyze the market. If you have any comments, questions, concerns, feel free to add those in the comment or reach out to me on social media. I'm happy to answer questions as they come in. But if this video is valuable for you, please go ahead and like, and stick around, be ready for the next one.